Here we go. Boom. So once again, as we were before, we went over that correctly. So scalping and intraday precision, the 1 minute, the 5 minute time frames. Remember, we do top down. That's why I went over with you guys with the NVIDIA chart, going from a 1 month, the 1 week, 1 day. You must do that before you start trading anywhere, so that way you know what to expect the market to do. And if you ever forget, just do it over. So if you decide to be a scalper or an intraday trader, you utilize high precision entries to capture rapid expansions. A primary execution window is the silver bullet time frame, which is 10 a.m. to 11 a.m. Eastern Standard Time. You look for the draw on liquidity, intraday stops, run targeting smooth highs and lows. Targets are these low time frame setups typically seek 10 to 20 pips as the algorithm seeks to clear immediate session liquidity. Day trading and session-based setups, so 5 minute to 15-minute time frames. Day trading focuses on the Judas swing, which is a manipulation move occurring after 0000 New York opening to create a false high or low before the true daily expansion. So duration is these setups follow the algorithm's 8:30 a.m. spooling and typically play out through the AM or PM session. Targets are the primary objective is low-hanging fruit, so defined as the -1 standard deviation of a measured move. That's, where did that go? We were just showing you guys what that looks like. This is the 1 standard deviation. There's other ones as well, as you can see here, 2 standard deviation, 4 standard deviation. And if it does make it down here to the 4 standard deviation, this is a full swing or something. I forget what they call it exactly, but it's like it's a thing. And that's what those are. So yeah, of a measured move. Now, short term and swing trading on the hourly time frame. Short-term setups focus on significant price legs that target previous swing highs or lows, and to identify these turns objectively, the 4-candle rule is applied. So a swing is confirmed by a center candle, one candle to the left, one candle to the right, and a 4th candle that breaks lower for a high or higher for a low than the center candle. The context here is pairs like USD and the Swiss franc are often choppy and favorable for turtle soups or false breakouts. So where did it go? Show you guys that again. So once again, this is where I was saying like that turtle soup would be like the area that I would see that, because it's like relatively equal low here. And typically what this price did was it came down and just broke past this, didn't stay there, just broke past it a little bit, and then it went back in the other direction. Now another thing is, what you probably see is price will probably come back down to around this area or range and then shoot up or something. I don't know if it's gonna actually do that, but that's what I tend to see sometimes happening. Or it just breaks below this and close, and now you're in a new like change of characters, what they like to call it. It's like it's now going in a different direction. And that's okay if it does decide to do that. You know, if it decides to go down, then hey, it's a downtrend for now. But you only lose from here to about here rather than losing from like somewhere up here to all the way down there. Like that's a profit margin for somebody. If you losing that much, that sounds tough. But you know, do your best.
True.
So next we have here source-based, the pip target source-based examples for hourly objectives include 42 pips, 60 pips, and 70 pips. The trade that you guys saw that I posted inside of the wins and losses yesterday, that one was about 89, almost 90 pips. I was going for 100 and change, 100 and some odd pips is what I was going for, and it popped me out of that position, and it was going on for a few days. So that is, you know, it makes sense. It's logical. Position trading and institutional swings, you would use the daily time frame. So position trading targets the parent price swing on the daily chart. These high odds opportunities require waiting for price to reach a deep discount, which is much below the equilibrium, or a deep premium, which is above the equilibrium. And the frequency and duration is opportunities for these setups form about once per week. The trade duration itself typically lasts several days to a week, and the target that you're looking for, large scale objectives extracted from the source, include 140 pips, 175 pips, 272 pips, 300, and 400 pips. The role of inefficiencies in price reaching. Inefficiencies act as stepping stones for the algorithm. When annotating a fair value gap, the volume imbalance must be included if it is located at the fair value gap high or low. Consequent encroachment. This is the 50% level of a gap. So a fair value gap, wick, or an opening gap, it acts as a point of sensitivity. So if the algorithm respects the consequent encroachment, it indicates strong institutional order flow. Gap lifespans. The new day opening gap, which is created between 4:59 and 6 p.m. Eastern Standard Time, is 5 days. That gap's gonna last 5 days, the whole week, or for one whole week, it's gonna be there. Then there's the new week opening gap. This is created between Friday at 4:59 and Sunday 6 p.m. opening, and the lifespan is 5 weeks, so a month and a week. Keep that in mind. Now, the trading style profiles, if you're a scalper, if you're a day trader, you're short term, or you're a position trader, it doesn't necessarily matter. It's just a matter of like what you're looking to get and what you're looking to, profit in these type of circumstances. So if you're a scalper, you're looking for 10 to 20 pips, and you're going to be on the 1 to 5 minute chart. And that means that you're looking for this to be done within 24 candles. If you're on the 5 minute chart, 24 candles is 2 hours. But if you did it on a 1 minute, it could be less than, it would definitely be about less than 30 minutes if you waited 24 candles on one thing. Come on now. Intraday stop runs is which the drawn liquidity is going to be the intraday, the current day's stop runs, and smooth highs or smooth lows, stuff like that. So you're trying to get it in that range of 10 to 20 pips, minutes to hour. And actually, let me show you guys what that looks like, so you know what the pips look like here. So where's my ruler? $20 pips. That's right. There you go. That's 20 pips. A little over 20 pips. But that's what 20 pip movement looks like. Dang, I can't move it around. Hold on. Let me see if I can make something right quick. Like this. Close enough. And then drag a line. Right there. Right there. Alright, boom. So we could take this and we could look around here, and you can see all these different places you could have made 20 pips worth of profit. How many times could you have done this? You know what I'm saying? It's really simple. It's not that hard. It's actually really easy. Goal to hit 10 to 20. Half of this is 10. You know what I'm saying? Double is 20 type of concept. So now you guys have an idea visually of what that looks like on a market. Like that's on a 15-minute chart. So if you're on a 1 to 5, you're looking for 10 to 20. Now if you're on day trading, you're doing 5 to 15 minute, which is where I tend to be, I will say. Then you're looking for standard -1 standard deviation. What is that again? It's this -1 standard deviation. So why is this -1? It's because it's like double from this range. So this here to this here is one range, and then you just double that down, and that's where you get your standard deviation 1. And if you were to, push it down even again, I think it does another one. So this is like, if you got in here at the very top and then it ran all the way down to a 2 standard deviation or whatever the case may have you would have made 100% here, 200% there, and then another 100% here. So that would have been 300% of 1 to 3. You wouldn't have risked anything. Let's say you've used this whole thing as a risk or whatever. Then you would have ended up. That's a hypothetical trade. I don't really want to tell y'all too much about those. It's just know the standard deviation -1 is right here, and that's what these other ones are kind of sort of doing. Even the 4 is literally just doubling it down. All right, so boom, let's move forward. Then there's the short-term traders, hourly, so forth, so on. This will take 1 to 2 days. The day trading takes 2 to 8 hours, roughly. Short term, you on the hourly chart, previous swings, four candle identification. Looking for that gap, the displacement or whatever, and then you're aiming for 42 to 60 or 70 pips, and this will take you about 1 to 2 days to get. And that you can do more, but you most likely won't go longer than that because the market will then try to do a big breath. And what I mean by big breath, meaning that it's going to retrace again around that time frame. And if you had a trailing stop loss, unless it was really, really low or really wide or something like that, it most likely took you out the trade at that point. And at that point, it's like, you should have just popped out. But these are things that you guys will learn as you go, like which one works best for you, like what do you naturally do on a regular basis, and you're going to end up creating like your specific way of trading for yourself. I'm trying to say it in such a way that you guys understand that like I'm giving you a reference point, a guide to kind of sort of like use as like, okay, this is kind of sort of what I need to be thinking in the range, the ballpark range of. But as you tweak it for yourself, you might do better or even worse than like the approximations that we have here. Like for example, a lot of times with some of the trades that I see that I do, I'll get in before I was supposed to get into that trade for whatever reason. I will, and it'll take longer than 24 candles for my trade to play out. But once it does start to play out, it plays out very quickly. You know where I'm going? Awesome.
Yeah, so are you essentially saying that you giving us like a reference of like where to enter and potentially exit a trade, and but except we're gonna be able to not just look at the numbers but come to that determination on our own because we understand why it's being done.
Yes, yes. Everything's being done because of the
That is
algorithm.
correct, Drew. I'm glad you're paying attention, bro.
Yes, all of the uh yeah. So all of these numbers here, they're just trying to help you understand like reference wise, like when you're in a trade and you're like, ooh, should I take it out now? It's about to reverse. It's about to do this. It's about to do that. On average, if you were correct, it's going to take at least a good 24 candlesticks before it can like fully do its thing. That's going up, that's going down, that's all that stuff in between. So if you find yourself inside of a trade longer than 24 candlesticks and it hasn't moved anywhere near close to the directions you want it to move in, that's a sign. Hop out that trade because there's a better one coming.
Hype ish.
hmm Now, if it has already started moving in that direction, you can put your trail on and let it do its
What's that?
thing
What
or
are
whatever,
those?
or let it do its thing or whatever the case may have you. So it's a personal choice. It just depends on how you like to trade. Me, in the beginning, when I started trading, I would do a bunch of market orders, and I didn't like the way market orders worked. And I tried out the limit orders, and I really liked that. But I didn't want to just sit there, so I tried out the stop orders and the stop limit orders. And after all of that, I came to the conclusion that I am a limit order trader. Like I am looking for the retracement to happen. Even before I knew what a retracement was, I was always like, I think price is gonna come down or go back up to this particular point, or I think it's gonna go back to a spot on the chart, and before it decides to continue on forward. You know what I'm saying? That's the thought process is in my head. And you could literally, without being taught any of these things that I'm teaching y'all right now, trade the exact same way that I trade by looking at the market in this type of way. And so it's like, how do you look at the market? How does it make sense to you from your perspective, your point of view, and how do you make that into a profitable trading method specifically for you? Because at the end of the day, I don't expect everyone's trading method to look exactly like mine. Like I look at some of the trading, styles that I see people do, like Monk and Truth. They have their own way of trading. At the end of the day, like Truth, she is trying to learn a lot of what I'm talking about, but she's also trying to make it um, fit the way that she trades. You know what I'm saying? Like she's trying to do something that makes sense to her. And I agree with that. Personally, like if I go and I do something new and something makes sense to me and it works, that's what I'm going to keep doing. If it doesn't work, then I'm not going to hold you. In my head, I'm thinking, okay, maybe this ain't for me. Because naturally what I want to do is this, and I'd have to be trained or conditioned outside of doing it this way in order for it to be done correctly. So the only thing they can tell me is I'm doing something I shouldn't be doing. That's a personal thing, separate from trading. But ultimately, this is something you can use in that way. Position traders, they look at daily charts. They do the parent swing and deep discount, drawing liquidity. and then the expected range is anywhere up to 4 or 500 pips, which I've never gotten a 400 pip, but I've gotten 300 pips before, and it feels nice. I will let you guys know it feels nice. It feels real good. And this could take several days to a week. And the more you go up, I ain't gonna hold you. If you're on the daily chart, that could take several weeks. I don't know why it says just to
Several
1 week.
weeks.
Yeah, several
It's
weeks. If
half
you're on a day, if you do
bro.
position trading and you get into a trade on a daily chart, 24 candles on a daily chart is 24 days. That's 3 weeks and 3 days.
Weeks and 3 days.
Yeah.
Bro,
So
that's how long
I guess once you
uh
start getting into the
Edmond
higher
been going.
higher time frames, you're probably going to want to like cut back on how far out or how long the candle should last. So maybe you could knock it down to it needs to play out in 7 days, which is crazy to me.
You ever
But
play 7 Days to Die?
no, we're talking about trading right now. So in this situation, just be mindful. I don't do this too often, or I don't really do this at all. Really, if it happens, it just happened like sporadically, or whatever the case may have you. But the short term definitely makes about 1 to 2 days or so. The day trading definitely 2 to 8 hours, and scalping, yeah, definitely
Yeah, I'm
one
a
to
scalper.
yes.
Yeah.
And so in that situation, if you are a scalper, that means you're aiming for 10 to 20 pips at a time, and you're getting in and you're getting out. You're trying to be out within 30 minutes if you can help it. Okay, awesome. So next is volatility and the manual intervention warnings. So the algorithm's program delivery can be superseded by manual intervention. Excuse me, during high impact news events such as CPI, FOMC, and NFP. Trading during these events is classified as gambling, as the intervention cannot be accurately predicted. So traders must wait for the data release at 8:30 a.m. before engaging. Observe how the algorithm spools at the 30-minute intervals. That's 7, 8, 9 Eastern Standard Time. And if the state of delivery does not align with these specific time windows, technical PD arrays, order blocks, fair value gaps, they will not hold. The algorithm only delivers price when the element of time is active. Like literally, your most important thing when it comes to trading in the market is this time. So you guys want to get used to that and understanding that more clearly. So, got here. All right, boom. So we also have this presentation here with just it's a visual representation of what I just went through for everything. So we're gonna go over it again so you guys can see it. Oh, look at that! Boom. All right, so the Fractal Time Horizon Playbook, an institutional guide to trade life cycles, durations, and yield expectations, mapping the IPDA from multi-month macro swings to 1 hour surgical scalps. The ultimate constraint: time precedes price. If you're not trading in the right time, you're gonna lose. You're gonna lose money. I don't know why you would think anything other than. I'm sorry. Go ahead. Hmm, that's fair. So the clock here, the algorithm spools liquidity based on a fixed daily and quarterly temporal windows. Understand that. The price is drawn liquidity. The DOL and inefficiencies dictate where the market goes, but only after time permits. So, as we can see inside of here, you got to draw liquidity right here, which would be an order block. This is the shortest or the lowest point before the move went up. So this whole candle would be a candlestick would be a drawn liquidity. Then it goes all the way up here. It created a swing high. That's another drawn liquidity. And then it created a swing low. That's another drawn liquidity. It went ahead and it broke above this drawn liquidity, ate a little bit of that liquidity, then displaced to the bottom. We know it displaced to the bottom because it broke this drawn liquidity here. And then we would draw our Fibonacci retracement from the top here down to the bottom here, and this range would be the 705 range, or the 62 to 705 range. And this is where you would enter into your trade, where the inefficiency is located in the market. So once you locate the inefficiency, you put your trade in, and then you put your target either to right here or to the 27, which is about right here, and literally price just delivers it for you in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candles. And then it starts to retrace a little bit, and then it'll continue down some more if it's still going to more liquidity that's below that. So you just keep that in mind. If it is not the right time of day, it will not work. Price action is meaningless outside of its programmed execution windows. Understand that or lose money. The SMC trade duration spectrum. So when we're looking at minutes, hours, days, weeks, months, scalping is in the range of 1 minute to maybe a few hours. Short term is in the range of, just before a few hours to, a few days. Swing trading is the, 2 weeks to 6 weeks. And position trading is 1 to 3 months sometimes. So, keep that in mind when we're also looking at these things. It ranges a long time. So if you're scalping, you're capturing the hyper-specific session liquidity sweeps. If you're short-term or day trading, you're capturing the average daily range, the weekly expansion. So that weekly chart is important to you, and even the monthly chart is relevant as well because it'll tell you like the overall trend. I mean, all of it is relevant, but you use these things for setups. Swing trading, which is much less. I mean, well, yeah, it can be 2 to 6 weeks for sure. That's perfectly fine. Capturing intermediate price swings, that's when you get a little bit more money. But it's like you determine for you what works for you. If you ain't got the capital to do a whole bunch of trades one after the other, or you don't got the patience or the desire to do that, then it might not work for you. Me, I stick around this short-term day trading range when it comes to trading because I'm not looking to wait a month to get paid anything from anybody. I just don't. I don't know. It's just not the way I operate. So that's a neat thing. Trade horizons diagnostic matrix. So you want to look at your bias chart. Your bias chart give you your bias if you're doing a position. You're looking at the monthly and weekly for your bias. What is a bias? Like when we say, hey, what's your daily bias? Is it bearish? Is it bullish? Is the market going up? Is the market going down? Once you understand where the market is going, then you go down to your next chart. So forth. So with position traders, the ones that got 3 months to wait before they get paid, you looking at the monthly and the weekly chart. And same thing with not same thing, but with the swing trading, you're looking at the weekly and daily. For day trading, you're looking at the daily. For scalping, you're looking at the 15-minute and 1 hour. That's just for the bias. Okay? That's just the bias. Now for execution, when you're looking to, get your trade set up and everything, or you setting up what you're trying to do, you're going to go down to the daily for the position, the 4 hour of the daily for the swing, the 15 for the day trade, which is where you guys see me at a lot. And then for scalping, it's the 1 to 5 minute. Holding time, once again, that we just talked about earlier, 1 to 3 months for the position, 2 to 6 weeks for swing, intraday, and scalping. Expected yield is you're looking anywhere from 5 to 1,000 pips. It just looks nice on paper to get that type of return. I don't know, it just is what it is, but that's that. But if you did swing, that's 2 to 500 pips or whatever. If you did day trading, you're looking at 50 to 100 pips, and if you're scalping, you're looking at 15 to 30 pips. You can determine for yourself which one is more worth it or whatever, and kind of sort of go from there. I like this range, so I stick in this range. And if I had to pick one, this would be the one I would pick. The frequency here, you'll probably get 1 to 3 setups a year with these position trades or sells or whatever, or trades. So keep that in mind. With the swing trading, 1 to 2 setups a month. With day trading, this is roughly 2 trades a day. Anywhere from 1 to 2 trades a day. Whereas scalping, you might get 2 to 3 setups in a session. Sessions is like New York session, London session, Asian session, so forth, so on. So keep those things in mind. Next, we have the mathematics of patience. So your return on your investments on the left, your win rates on the bottom, and so the higher time frame targets drastically offset poor accuracy. 3 wins, 5 R versus a 7 losses, a negative 1 R. equals a plus 8% net return. 3 wins versus 7 losses still equals a 2% uh, net return. Even losing 70% of the time yields profitability. So take that into account. Uh, I don't know. I don't know about none of this win rate below 70. I just don't see why anybody would do that. It just, in my opinion, sounds like a bad idea, personally. So I'm normally around like trying to get 70%, 70 to 80, and if I can increase it beyond the 80, that'd be even better. But 70 to 80% win rate is ideal in an imperfect world. Let's keep it that way. So, key takeaway here: extending your trade duration allows for 5 to 1 risk reward ratios, mathematically immunizing your account against low accuracy. So, the good thing about this method of trading is that it really does do a good job of giving you good profit, like risk reward ratio. Like it's like mapped into the whole system that you're gonna get at least a 3R. You know, risk reward. So 1 to 3 risk reward. So just keep that in mind. Now the 24-hour cycle. Once again, we're looking at that AMD distribution, accumulation, manipulation, distribution that we talked about before. When we're looking at the trading day, I guess you could say. You have your phase one, which is accumulation, and typically that happens in the Asian session, depending on the commodity you're trading or asset you're trading. It builds the range, engineers liquidity pools above and below that range, so the way it can then sweep them inside of the manipulation phase or the Judas swing that they like to say. This happens sometimes during the London Open or the London session, and pretty much you'll see break outside of that range while then having a hard time staying outside of that range. And then phase three is distribution, which is that expansion that we're looking for it to do, the true directional expansion, delivering price to high time frame targets. And this is where I would draw my Fibonacci retracement tool from the bottom to the top, bottom to top here, and then wherever the 62, 705, or 79 points are, and that I will go ahead and enter into a trade at those points, and then that would literally be it for the trade for that one, and then I would move on to the next trade. Next here is the position trade, 120 days open float with your target being a 600 pip yield. So this means like you start off down here and then it does its thing where it goes up, it goes down, goes up, goes down, then goes and hits your target. That's what you want it to do. So the blueprint, capturing quarterly shifts driven by interest rate differentials and institutional intermarket analysis. Look back window is 20, 40, and 60 day. IPDA data ranges to identify the highest highs and lowest lows. Execution rules: enter on daily chart order blocks. Trail stops loosely below 40-day lows to survive deep market retracements. Expectation is anywhere from 5 to 1,000 pips held over 1 to 3 months. And it only requires 1 to 3 high probability setups per year. With the swing trader, the weekly chart containers is pretty much going to go through all of them, guys. So, as you can see, it started displacing down. It created a fair value gap, and then it went up and it created an inverse fair value gap a little bit at parts of it, and then it continued on towards a particular target. So that's something to take into account. So capturing roughly half of a quarterly cycle by aligning weekly order flow with the daily or 4-hour execution. And you would end up waiting for price to reach a monthly or weekly discount array. Enter when the 4-hour chart shifts structure in alignment with the higher time frame. You're expected to get 2 to 500 pips over a 2 to 6 week duration. Tighter stops, which is roughly about 50 pips compared to position trading, and this allows you to target a massive 10 to 1 or a higher risk to reward ratio. When you start going down to lower time frames, it's only for one of two reasons: either you don't have enough money, or you want a tighter stop loss. You want to mitigate more of the losses you could potentially take by making the trade that you're trying to make. Then if you do short-term intraday trading, this is once again we end up seeing that consolidation, then that expansion outward. Then we see it reversing back down or retracing back down. Oh, and then it broke this previous low over here, and it's creating a manipulation below this range. It manipulated here and it manipulated here. If you was following this down, you most likely would have lost money when it if you thought it was going to go up here, and then when it came back down and it showed you that it was going to do it again, displace the Judas swing. This is manipulation, and then it starts to go above. Once it broke above here, this is when you're saying, oh, okay, good opportunity to enter into a trade. So right here it broke above, and technically that's where they would have told you to enter. I wouldn't have entered this trade. That's a personal thing, but apparently they would have. I would have literally just took my loss here and waited to see what it decided to do, and would have looked at an older time frame in there. That's just what I do. This one, consolidation, this manipulation. I would have looked at this like this is expansion, because that would have been manipulation. It looks like a manipulation because it goes up, then struggles, then comes down, then it moves down. This looks more like proper displacement. This didn't look like displacement, but hey, it is what it is. I would need to see before this in order to see where this was going, because that's a little deep. I don't know. It just looks a little deep. But anyways, so the blueprint here, you're going to be exploiting the weekly profile, Tuesday, London low. Once again, I tell y'all I don't trade on Sundays and Mondays for a reason. And honestly, I use a different way of processing this information. I use a VWAP line. I use a VWAP session, week, and quarter to see, or month, to see what it's doing. And typically that helps. I'm not going to hold it. It does a pretty decent job. And as I'm learning more about it, I will eventually be able to let you guys know. But I want to be certain before I share that info with you. But next we have the execution rules. You want to define the daily bias. Wait for the Asian range to consolidate. Asian range consolidate. And we want to execute on the 15-minute chart following the London Judas swing. So the way that this one tells you is determine what the daily bias is. Average daily range, ADR, target. So they think that price is going to go up to this point. So boom, we want to wait for that. That's what it's saying here. And so it was wait for an Asian range consolidation. So it consolidated over here. And if we think about it, what is that? So if this is New York, because this is Asian, this means this is New York, and it means that this is London. London consolidating. So if London consolidated, ignore it. You want Asian session to consolidate. If the Asian session consolidates, that means that the London session should be a Judas swing, and then you should go on from there. But if it doesn't, then this should be the Judas swing, and then this should go from there. And honestly, if you think about it, that is correct, because this would have been London consolidation, New York expansion, and then it retraced, or reversed rather. It would have reversed here down, or it looks like it reversed. I'm not gonna hold you. And then it followed it, went down, cool, boom, it broke past. Probably got you your 2.7 at this range, maybe even a 0.5 or the 50, and then it went into another expansion in the other direction. So it's just in this type of situation when you're trading, you want to keep in mind all the different possibilities that the market could do. Like, you could be wrong. Like, I always think of that when I'm trading, because if you're not thinking about that and it starts to go in a direction that shows you wrong, it starts to make you think that starts making you second guess your trade. You don't want that. You don't want that. As for profit taking on this, it says here liquidate 60 to 80% of the position upon reaching the ADR projection. So once price gets up here to this point, if you have a whole lot size, you want to go ahead and close out anywhere from 0.60 to 0.80 of those lot sizes, in order to make sure that you're getting paid. I always make sure to tell you guys, get your paycheck, okay? Get paid for trading. If you don't get paid for trading, you're going to get burnt out mentally from doing this, because it's like, if it don't make money, it don't make sense. Y'all know how we are, type shit. So 50 to 100 pips is the expectation with a short-term intraday trade exited either at the close of the New York session or held 1 to 5 days until the 5-day ADR is reached. Next, we look at the scalpers, the surgical scalper. So here we are, the silver bullet and killer B models, fast-paced, high-probability setups, executing strictly within kill zone times. It requires higher time frame bias from the 1 hour and 15 minute. You want to wait for a local liquidity sweep and displacement, and then enter on a 1 or 5 minute fair value gap. Expectation is anywhere from 15 to 30 pips total, yield, and you're gonna go for that. The duration constraint here is it takes 1 to 2 hours maximum, and do not hold through lunch hours or overnight. That's why I be telling y'all don't hold overnight. You're gonna get charged for that, and don't hold through lunch because that's a wrap. Type of concept. So typically, if you get in on a 10 a.m., you trying to be out by 11:45. So with this, you'll see this is the range, the silver bullet range, or whatever the case may have you. So down, up, down. I do not scalp, so I'm trying to figure out how they decided to put this together for you guys. Let me see. This create the fair value gap. Okay, so it doesn't show you the target in this, which is unfortunate, but it's telling you pretty much because you're only looking for 15 or 10 to 30 pips at a time. Any of these here where you entered in at the order block or whatever would have pushed you up, if that makes any sense. This would have pushed it up just enough to create that 15 to 30 pip total yield. So I don't scalp. I don't like scalping. It's too fast and not enough profit for me. Like I said, I like seeing larger numbers. I'm okay with 50, more so than I'm okay with 30. I'll put it like that. Next is the alignment engine fractal market mechanics. So everything is fractal. If you don't know what fractal means, it's like the law of correspondence where, you're able to find the same thing happening on smaller time frames or in other places it correlates or corresponds to. So smart money concepts trading is not isolating time frames, it is nesting them. So the synthesis is the 1 minute 20 pip scout works because it is executed inside the 15-minute manipulation, which is reaching for a daily liquidity pool driven by a monthly bias. The rule of thumb here is if your parent chart dictates direction, your execution chart limits risk. Do you guys understand what that means? Fantastic. Trade lifecycle management and scaling. So there's the entry, the lifecycle gauge, and then the exit, right? So once you get your initial strike into the trade, that's the 20 to 30 pips gained or first objective. You want to take 30% of your position off, off to bank 1 to 3% equity, and then move stop loss to break even. And this is what you could do. This is an example, reference. I don't do this one specifically, but you could do this and you can make your own. Then your midpoint, 50% of the intended objective gets reached on higher time frames and anticipate a retracement occurring around this time frame. New buys can then be added to restore the initial 30% taken off, but ultimately you want to get paid. Like we trying to get you paid. Like I know y'all want to get paid. Like nobody is trading in the market not wanting to get paid. Get paid. Then finally, your terminal target, the thing that you're actually looking for to make it to. Once it gets reached, it's a part of an opposing PD array, and you want to get out of that trade because it's not going to go good if you continue to hold on to it. Unless you follow on a longer term trend, but in which case, that's a different story altogether. Action here is to collapse 80 to 100% of the position at that particular point in time, and you'll be good to go. The rule of temporal invalidation, the axiom. If it is not the right time of day, it will not work. Time first. Time-based failure. If price hovers near a 15-minute discount array for too long without an immediate aggressive displacement, the probability of success severely drops. Like when I tell you guys, that's what I was saying, you need to get that idea. Like, hey, 24 candles is the move. Like it should be done around that time frame. If it ain't move out of that range within 24 candles, what you doing? Like, why are you still here? Like literally, the market is being hella lenient with you, letting you sit here all this time with your trade in a loss. Like it's a losing position that doesn't have much hope or much evidence of being successful. So hop out that trade. And if you could hop out around break even or a little tiny bit of profit, this tiny profit, even a mosquito got meat. Kill zone discipline. If an entry limit order does not execute during the volatile London or New York kill zone, just cancel the order. Do not let pending orders trigger during dead volume hours. So be careful with that. That's something I need to do, is make sure that my orders ain't triggering before I want them to trigger. So it's almost like one or two things you gotta do. Either you gotta leave it in there or just be wary. You know what I'm saying? Like if your order gets triggered in an off time, you enter too early and you're gonna be in some drawdown. That's an unfortunate thing for you, but you'll be all right. Next, selecting your temporal reality. So, what is your trading constraint? You got limited screen time, but you got a lot of patience. Position and swing trading might be for you. If you got moderate screen time and you need daily closure, intraday trading is for you. Now, if you got a lot of time on your hands and you want immediate feedback for whether or not you're doing good or doing bad, scalping is most likely going to be the thing for you. Trading mastery isn't about capturing every time frame, it's about ruthlessly dominating the one that aligns with your psychological mindset and your schedule. So keep that in mind. And that is the end of the slideshow for today, guys. I appreciate you all showing up. Are there any questions or concerns at this particular point in time in the lesson?
Yeah, I don't know if you remember, but earlier you were talking about moving your stop loss and then eventually doing away with it when you're in profit.
Mm-hmm.
Uh, when would you like do away with it? Because I'm not gonna hold you. I'd rather my stop loss get triggered and then it bounce than to like, you know what I'm saying, end up
Yes.
back not in profit.
So I'm not saying you completely remove the stop loss. What I'm saying is you remove the stop loss from losing you money. So you put your stop loss in profit. So like, let me see if I can give you an example here.
Okay, I get you saying like move it up. Like, okay, yeah,
Yeah.
that's what I.
Yes. So they have a feature in most brokers called a trailing stop loss. So you can probably put that a trailing stop loss and say, hey, cover it 40 pips, like 40 pips away from where it currently is. Leave it at that, and then like gradually move up. If you have it around that particular range, you shouldn't really get tapped out of your trade, overly too soon or anything like that. But you also want to have a take profit available as well. So like, and the reason why is because you're trying to get like the very top. Like you want the maximum amount of money that you can get inside of any particular trade. And if you put it at a particular point at the top for TP, that's where you think the price is going to reverse and go in the other direction. So in my head, in a perfect world, the best trader is someone that can literally go from trade to trade to trade to trade. Like literally, I enter here, exit there, and when I exit there, it enters there, and going in the other direction, and then so forth and so on. Like if I could predict how to do that, I'd probably do that.
Okay, yeah, and towards that. Well, on the last slide, I'm definitely more of a scalper. Just
Hmm.
realized that the other day.
Yes. So if you got a lot of time to sit in front of the charts, and what I would tell you is use a demo account. Because scalping is a very quick thing. A lot of times people that scalp use market orders rather than limit orders. Because it's happening and it's going to happen relatively quickly. Like we said, less than 30 minutes you should be out of that trade.
Yeah.
Definitely less than an hour you should be getting out of that trade or getting close to getting out of that trade. Type of concept. So with these
Set
type
up
of,
a demo account on Athens too.
say that one more time.
I set up a My bad. I set up a demo account on Athens too.
Fantastic. So just go ahead and like get used to catching a setup, trading the setup, and then making profit with that setup. And like understand your target is 10 to 30 pips. So if you're getting 10 pips, and if it goes above 10 pips, break even. You don't want to lose no more money. It goes to 20 pips, and you aiming for 30, put that on like 5 pips. So the way you at least get a little bit of money if things like, reverse on you. You ain't losing money in that situation, but you ain't going for a lot anyways. But at the very least, you ain't losing no money. And uh, after that, it should hit the target that you're aiming for, which is either the 30 or whatever you had it at. I mean, you could probably move it up. Yeah, no, that's fine, because it's not enough space for it to do anything other than. So once it goes into profit significantly enough is when you should be trying to move your trade into some type of profit. You can either partial close some of it so the way you get some money coming in, or you could just close the whole thing once it gets to your target. All of these things make sense and they do work, and it's just up to you of how you want to go about doing it.
Okay.
All right, awesome. And are there any other questions or concerns for today? Well, fantastic. So what I'm going to do, guys, is I'm going to end the recording here.